The other big thing with these plans, whenever they're employer-sponsored plans, there's a big added advantage. And this goes back to the Medicare tax, the 3.8% Medicare tax. So let me tell you what I'm talking about. You put money into a traditional retirement plan, a cash balance plan, profit sharing plan, you get a huge tax deduction up front, and then in your retirement years, you pay taxes on it as you pull the money out. That we already know. I said that about 5 times today. Hopefully, in your retirement years, if you're in a lower tax bracket, where you move out of a state like New York and move like to Florida or Texas, where there's no state or city income tax, you'll permanently avoid the state and city income tax when you start pulling the money out in a state that charges little or no state or local income tax. But here's the other key thing. That 3.8% Medicare tax, when you set up an employer plan, you permanently avoid. This is not tax deferral we're talking about. We're talking about permanent tax avoidance. So let's just say hypothetically, you put away $200,000 into one of these plans, employer contribution. That avoids the 3.8% Medicare tax. 3.8% on 200,000, that's what, 7.6, right? If I'm doing my math right, you just save yourself $7,600 on a $200,000 employer retirement contribution. That is a permanent savings, period, end of story. It is not inexpensive to set up these sophisticated plans. You have to expect it's going to cost you minimum $5,000 or $6,000, maybe $7,000 in administrative costs to set up a 401k profit sharing plan as well as a cash balance plan. And then there's also annual costs associated with that. Those fees you pay to a plan actuary. They're the ones that design the plans. They're the ones that amend the plans for you. They're the ones that make sure it complies with the IRS regulations. And then they alter the plan every year when they work with your tax and financial advisor so that we could use the plan to your advantage every single year. But the takeaway here is, even though there's a big cost associated administratively to set up these plans, just the Medicare tax savings alone will more than cover any cost associated with setting up these plans. So you're getting the benefit really free of charge. And in a few minutes, I'm going to explain to you that there's also other tax credits the government will give you as well. So this is really a game changer. I had a client about 4 years ago that was sitting right where you guys were. He's a successful dentist upstate New York, making over $1 million a year. He was using his local accountant, literally local. His dental office was here. The building next door was the accountant's office. It was a convenience made in heaven because they was right next door. So for the first 35 years he was in practice, he took convenience over working with the dental CPA. After he sat in my lecture, he called me and said, "John, could you look over my tax return?" I did just that. I came back with a list of about 12 things he wasn't taking advantage of. And it was really a crime. But one of the first things we did, because he was already 65 years old at this time, we set up one of these plans. The guy couldn't thank me enough. The first year alone, in implementing all these strategies, his tax bill went down by over $400,000 in year one alone. And then every year since then, he's saving a similar amount. And with his cash balance plan, in just a matter of 4 years or so, he currently has a little over $2 million set aside in his cash balance plan. That alone, that $2 million, already saved him over $1 million over a short period of time. So these are extraordinarily valuable tips. If they apply to your situation, got to take advantage of it. Just make sure you have that conversation with whoever your tax advisor is. Okay, so in addition to that, the IRS wants to motivate you to set up retirement plans. Now, why does the IRS want to motivate you to do that? Because they want to make sure you do the responsible thing. They want to make sure that you don't end up on welfare or government assistance in your old age. for social benefit, they want everybody to save for their retirement. So if you're good enough to set up one of these plans, there's a tax credit that could be $500. It's a greater of $500 in one example, which is 50% of your expenses, but it could be as much as $250 per employee. Doesn't include highly compensated employees, so you don't get that $250 for yourself, your spouse, and your highly paid dentist, but all of your other staff people, you could get back $250 tax credit. The maximum per year of a tax credit is $5,000. And you could get that $5,000 credit every year for a 3-year period. Now, this is not just for new plans that are set up. This is not just for new plans that are set up, but let's say you had a simple plan before, or a solo 401k, but almost nobody was participating. Now that you switch to a plan where a lot more people are participating, you're going to be able to take advantage of this. So here's another $15,000 that I could save you simply by implementing this strategy. Again, if this is not a conversation you're having with your investment advisor who's helping you set up the plan, or your tax advisor, you definitely want to have this conversation.